Daniel.
And I'm Mira.
You know, it's a bit like finally fixing a stubborn leak in your roof.
Oh, I know that feeling.
Right, like you patch the shingles, you dry off the floors, and you just feel this massive sense of relief because the immediate threat is gone.
Exactly, the crisis is averted.
But then, just as you're celebrating in your dry living room, you look down and realize, wait, the entire foundation of the house is slowly sinking into the mud.
Which is terrifying because, the structural decay underneath is what eventually brings the whole house down.
Spot on. And in today's deep dive into the market sources, we're seeing exactly that tension playing out in the U.S. economy on Wednesday, August 12, 2026.
It was definitely a day of two very different extremes.
It really was. The S&P 500 climbed back to 7,748.50, and we saw gold stage this spectacular rally near $4,500. And this was all kicked off because an inline U.S. CPI report successfully calmed those immediate rate hike fears.
Right, so that was the roof leak getting fixed.
Exactly. But then a jarring reality check hit the bond market later in the day. 10-year Treasury yields spiked to levels we literally haven't seen since 2007.
And there goes the foundation.
Yep, sinking into the mud. So, to understand the baseline you are operating against, we are going to cover three main sessions today.
Right, so session one is going to look at the global geopolitical and energy setup, which is pretty chaotic.
Extremely.
Then session two breaks down the inflation and Treasury data that really dominated U.S. trading. And finally, session three unpacks some key corporate events, including a massive hardware crunch at Google and a huge AI forecast from Cisco.
Sounds like a packed show. But real quick, before we jump in, a clear disclaimer for you all.
Yeah.
This briefing is designed for market context and discussion only. It's not personal investment advice or an investment recommendation.
Absolutely.
All right, session one. What set the stage before the U.S. session?
Well, basically a massive global energy tug of war.
Yeah, looking at the overnight data, I was just struck by the sheer contradiction from the world's leading energy agencies. And this was right at 1 a.m. Eastern time.
It was completely wild. The International Energy Agency comes out forecasting a 1.8 million barrel per day deficit for the third quarter, pointing directly to Middle East disruptions.
Right. But then, at the exact same time, OPEC completely slashes its 2026 demand growth forecast to just 580,000 barrels per day.
Yeah, and they noted that their own July output actually rose by 1.42 million barrels per day.
If you're trying to allocate capital in the energy sector, that 1 a.m. wake-up call makes pricing physical risk almost impossible.
It creates total analytical paralysis on trading desks.
Exactly.
Like when the paper forecasts from the IEA and OPEC are moving in completely opposite directions, traders are forced to just ignore the spreadsheets and look exclusively at the physical supply chains.
The physical reality on the ground overnight was highly volatile.
Highly volatile and very kinetic.
Yeah, at 12:24 a.m. Eastern Time, reports hit the wire that Ukrainian drones targeted Russia's Novorossiysk naval base and the Orsk refinery.
And that strike on the refinery forced them to completely halt crude processing.
Which is crucial, right? Because when a refinery goes offline, you don't just lose the end product like gasoline or diesel.
No, you create this localized bottleneck of unprocessed crude that totally warps regional pricing.
Right, while simultaneously starving the broader global market of finished distillates.
Which injects a massive physical risk premium back into the market instantly. You can't refine crude if the cracking units are severely damaged, no matter what OPEC thinks about global demand cooling.
So true. And the supply chain choke points were just being squeezed on multiple fronts.
Yeah, over in the Middle East, at 6:49 a.m. Eastern Time, Iranian sources formally rejected any claims of progress on a U.S. ceasefire.
Oh, wow.
Yeah, and they warned quite explicitly that large ships still cannot pass the Strait of Hormuz.
Right, which prompted former President Trump to post on Truth Social, basically referring to the U.S. blockade of Iranian ports as a wall of steel.
The rhetoric is definitely escalating.
It is, and I think this is where we need to remember that framework of geopolitical escalation as game theory brinkmanship.
Right, because it's so tempting for the market to treat these disruptions like unpredictable natural disasters, like a hurricane that just sweeps in.
Exactly. But it's not random chaos. How is this really just a calculated pressure campaign over trade and sanctions?
Well, the leverage they're applying, it's purely economic. I mean, the Strait of Hormuz accounts for roughly 1/5 of all internationally traded oil and natural gas.
That's a huge bottleneck.
Right. So by weaponizing that specific shipping lane, they know a sustained spike in crude prices acts as a multi-channel margin tax on Western economies.
Ah, right, because it drives up marine freight rates.
Exactly. And it inflates raw manufacturing inputs, and it squeezes consumer discretionary spending at the pump.
Which obviously puts tremendous political pressure on Western leaders, especially right ahead of election cycles.
Exactly. And the U.S. port blockade, that wall of steel, is the counterlever. It's high-stakes negotiation being played out with drones and naval destroyers.
Wow. Okay, so heading into the U.S. Open, we had this incredibly tense cocktail of conflicting agency data, refinery drone strikes, and just raw geopolitical friction in Hormuz.
It really left energy markets highly volatile.
Definitely. So we'll take a quick break here, and when we come back, we'll dive into how all of this collided with the U.S. macro data.
Sounds good.
All right, we are back. Session 2. What moved markets during U.S. trading hours?
The defining battle of the U.S. session was really between morning inflation relief and afternoon Treasury gravity.
Yeah, the catalyst hit at 8:30 a.m. Eastern Time with the July CPI report. Core CPI cooled to 2.5% year over year, and supercore CPI fell to 2.843%.
Which gave the Fed exactly the non-housing relief they were looking for.
It really did. I mean, this inline report acted as a massive relief valve for equity markets. The U.S. dollar index momentarily dropped to 99.64.
And we saw S&P 500 futures surge to an intraday high of 7,784.75 by 8 a.m. Eastern Time.
Which is 12.00 UTC for those tracking globally.
Right. The market had been terrified that sticky inflation would force aggressive rate hikes, so this print felt like the ultimate all-clear siren.
Oh, absolutely. And that relief was compounded just 2 hours later by a huge shift in domestic commodity logistics.
Yeah, at 10:30 a.m. Eastern Time, the EIA reported a staggering, completely unexpected build of 17.422 million barrels in U.S. crude stockpiles.
17 million. I mean, we were expecting a draw, and instead we got the largest weekly increase since early 2023.
It wasn't just a rounding error. It was driven by a massive surge in net crude imports.
Right, including a multi-year high coming from Venezuela.
Exactly. And the mechanics of a build this large fundamentally alter the macro landscape we discussed from the overnight session.
Yeah, bringing back that oil shock as a multi-channel margin tax frame. When domestic storage tanks are physically overflowing, it acts as a sudden relief valve against that tax.
Exactly. If domestic refiners are swimming in crude, it really mitigates the geopolitical premium from the Strait of Hormuz.
Right. It protects corporate margins from being eroded by those energy costs.
It perfectly illustrates how domestic supply dynamics can just temporarily neutralize international brinkmanship.
But the equity market celebration didn't last, did it?
No, it was abruptly cut short. The tone of the day entirely fractured at 1 p.m. Eastern Time.
Ah, yes. The $42 billion 10-year Treasury note auction.
This is where we look down and see the foundations sinking.
Yeah, the auction drew a high yield of 4.683%. That is the highest yield since 2007.
And the demand was visibly soft. The bid-to-cover ratio was just 2.53.
But wait, explain why this halted the stock market rally in its tracks. I mean, if CPI is cooling, why does a weak Treasury auction matter so much?
Well, it comes down to the mechanics of a failed auction. When the bid-to-cover ratio drops that low, it means end buyers, like foreign central banks, pension funds, are stepping back.
They don't want the debt at that price.
Exactly. They are refusing to buy U.S. debt at the offered price. So this forces primary dealers to swallow massive amounts of inventory they don't actually want to hold.
Right.
So to clear the market and find buyers, the Treasury had to let the yield tail significantly upward.
And when that 10-year yield spikes to 2007 levels, it triggers an immediate reaction on Wall Street. This is that dynamic of risk-free yields as gravity compressing multiples.
Precisely. Equity valuations, especially in tech, are heavily reliant on the discount rate.
Right. So if the U.S. government has to offer almost 4.7% just to fund its own deficit, does that prove borrowing costs will remain a massive headwind for equities, regardless of cooling consumer prices?
Yes. That sheer cost of capital acts as a gravitational pull on stock prices. That multiple compression is exactly why the 10-year yield spike erased the morning's equity gains.
It's wild. 10-year Treasury futures, slid all the way down to 108.48 by the U.S. close.
The market had to just abruptly pivot from cheering a patched inflation leak to realizing the structural cost of funding the U.S. deficit is a massive headwind.
It's a harsh reality check. Okay, let's take one more short break, and then we'll jump into the corporate news to see how this is playing out on the ground.
Perfect.
All right, we're back for session 3. Let's dive into our corporate events recap and what to watch next.
So that tension between physical supply constraints and rising capital costs is playing out directly on corporate balance sheets.
Oh, absolutely. We saw this vividly at 10 a.m. Eastern Time with Alphabet's debut of the Google Pixel 11 lineup.
Yeah, Google was forced to immediately raise prices on the new devices, and they explicitly cited a severe memory chip crunch in the global supply chain.
This perfectly captures AI infrastructure constrained by physical power and manufacturing. It is just not a software coding race anymore.
No, not at all. And behind the scenes, co-founder Sergey Brin is reportedly urging staff to refocus entirely on getting their Gemini AI model back to the forefront.
But Gemini requires massive amounts of high bandwidth memory to run those localized tasks on a phone.
Exactly. If hyperscalers have bought up all the available memory for their server farms, consumer hardware just gets starved out.
Right. You can have the smartest AI model in the world, but if you physically cannot source the silicon for the handset, your monetization hits a hard wall.
And that focus on physical constraints over software ambition is driving major shifts in trade policy, too.
Oh, right. The Ford news.
Yeah. At 4:50 p.m. Eastern Time, U.S. Commerce Secretary Howard Lutnick announced that Ford is bringing manufacturing jobs back to the U.S.
Specifically citing the Section 301 protective tariff regime.
Exactly, which is a carryover narrative from the macro briefings we tracked earlier. The tariffs act as this blunt force mechanism, forcing the repatriation of physical supply chains.
Because absorbing those import taxes just destroys margins.
Right. And Lutnick also previewed a major announcement for tomorrow regarding a new Apple Mac mini factory being built in Texas.
Wow, so the reshoring trend is really accelerating. But I think the most staggering corporate validation of the day came right after the closing bell at 4:05 p.m. Eastern Time.
The Cisco Systems Q4 earnings.
Yes. Cisco delivered a blowout forecast. I mean, we constantly talk about AI CapEx as a self-referential valuation loop, right?
Where people fear tech giants are just buying GPUs from each other without generating real-world revenue.
Exactly. But Cisco CEO Chuck Robbins cited clear visibility into multiple AI hardware design wins across their custom silicon over the next 6 months.
Yeah, they were projecting their annual AI-driven revenues will reach $7.5 billion by fiscal year 2027.
So hyperscaler spending is now showing up as highly tangible revenue for foundational suppliers like Cisco.
It proves the capital deployment is actually flowing down the hardware stack.
You know, it's like the tech industry is trying to build the world's fastest sports car. Cisco is proving they have the contracts for the engines, but Google's price hikes show we are rapidly running out of the raw steel to build the chassis.
That's a great way to put it. The capital is there, but physical manufacturing is the bottleneck.
Which brings us perfectly to today's closing bell joke, straight from the trading floor.
Let's hear it.
Well, folks, that's the closing bell on a day where inflation finally behaved. But our wallets are still bracing for a memory wipe. Google debuted its Pixel 11 today, but immediately jacked up prices due to a severe memory crunch. Which is highly relatable, because after seeing today's 10-year Treasury auction draw its highest yield since 2007, most bond traders are wishing they could experience a severe memory crunch of their own. At least Cisco's blowout $7.5 billion AI forecast means the robots might actually have the budget to buy those overpriced phones. Let's ring that bell and celebrate surviving another wild day on Wall Street.
Surviving really is the operative word today.
It really is. So what should we watch next?
Over the next 24 hours, obviously monitor how the broader market reacts to Cisco's massive earnings print on Thursday. Then, at 8:30 a.m. Eastern Time on Thursday, we get the July PPI, the Producer Price Index, along with weekly initial jobless claims.
Got it.
And then at 1 p.m. Eastern Time, there's a U.S. Treasury 30-year bond auction. Given that abysmal bid-to-cover ratio on the 10-year today, that 30-year auction is going to be heavily scrutinized.
Yeah, looking for further signs of primary dealer exhaustion.
Exactly. Also, keep an eye out for continuing Strait of Hormuz headlines, as that remains a highly volatile constraint. And finally, Applied Materials reports earnings after Thursday's closing bell.
which will give us a crucial read on whether the semiconductor equipment cycle has the capacity to alleviate Google's memory crunch.
That pretty much wraps up the major fundamental drivers for the day.
All right, now let's